What's going on, everyone? My name's Obi and welcome back to the Courtside Financial Podcast. Today is Thursday, October 2nd, and I want to talk about something that's been on my mind recently. As a NIO bull, I spend a lot of time thinking about what it actually takes to survive in this market. And companies like Leapmotor show us that selling cars is the easy part. Staying alive is what's actually hard. Let me paint a picture for you. September 25th, Leapmotor celebrates hitting 1 million vehicles produced. Major milestone, right? Same day, same exact day, their founder, Zhu, labeled a deadbeat debtor over a contract dispute. The man couldn't even enjoy his champagne before getting restricted from high consumption by the court. But that's what I call dramatic irony. And here's why this matters to us. Leapmotor just hit 50,000 monthly deliveries, turned their first profit, and their founder is still saying they haven't even crossed the line between life and death. That should terrify you and excite you. Let me explain. Let's talk about what Leapmotor actually accomplished this year, because the numbers are impressive. From March through September, 7 straight months, they've been on an absolute tear. March, 37,000 vehicles. April broke 40K for the first time. July cleared 50K, and September over 60K. That's roughly over 338,000 vehicles delivered in 7 months. They raised their guidance from 500 to 600K units to 580 to 650K units. They also topped the new car manufacturer sales for 7 straight months. Their gross margin, it hit 14.1%. That's a new high for the company, and they actually turned a profit in the first half of the year. By every traditional metric, this is a success story. This is the dream, right? Wrong. Here's where things get interesting. Zhu, off his 3-day experience as a deadbeat, things got resolved kind of quickly. He immediately set a new target for 1 million units for 2026. That's a 53.8% jump from that 650,000 units guidance. Why? Well, because according to him, the million is the bottom line for survival. Below that, you live a very tiring life. Now, I want you to sit with that for a second. Monthly deliveries of 50K plus units, profitability, first profitability, and the founder is still saying basically that they're struggling for dear life. Let me break down the economics, because this is where it gets real. Leapmotor just escaped losses, but look at actual profitability. Cash flow just turned positive. Cumulative net profit less than 500 million rent. Net profit margin 1 to 2%. That's razor thin, so they're susceptible to one bad quarter. Price war intensifies, raw material costs spike, subsidies get cut, and boom, Leapmotor is back in the red. At their current scale, their fixed costs and R&D eat up almost all of their profit entirely. Their operating leverage is maxed out. They're running on a treadmill where if they slow down even just a little bit, they fall off. But here's the calculation Zhu is making. Hit 1 million units and everything changes. Supply chain pricing hits the million level threshold. That's a 3 to 5% reduction in procurement costs right there. R&D and production line depreciation get diluted to a safe level. Capacity utilization improves. Cost per vehicle drops. Net profit margin jumps from 1 to 2% to 3 to 4%. Run those numbers. Annual profit goes from 500 million rent to 4 to 4.5 billion rent. That's not incremental, that's transformational. That's the difference between just surviving and actually having breathing room to invest in your future. Now, for my NIO bulls out there, and I know that's most of you, this should sound familiar. This is exactly the scale game that NIO's been playing. Why do you think NIO's been so aggressive with Envo, the multi-brand strategy? Why battery as a service brings cars into the 150,000 REN range? Because they understand the same brutal math. The difference is NIO went premium first, built the technology stack, established the brand, and now they're scaling down to establish volume. Leapmotor went the opposite direction. Volume first and then scale up market. Both strategies have merit. Both are risky. But here's what I think. NIO's approach gives you more defensibility. When you've proven you can compete at 300 to 400,000 REN with the BMWs, the Audis, the Mercedes. Coming down to 150,000 isn't a compromise. It's a flex. You're bringing premium tech to mass market prices. Leapmotor, well, they're trying to go from half off-price Li Auto to launching a D series at 300K Ren, that's much harder perception shift to pull off. Now this brings me to Leapmotor's problem. They won on hardware specs, but they're losing on actual experience. Their whole strategy has been full self-area research that they develop in-house. Electronic architecture, 3 electric system, even components like R-HUD and seats. The goal is to cut out supplier margins and pass those savings on to the customer for Leapmotor. It certainly worked in getting traction though. The C11 was their poster child, 150 to 200,000 Ren price point, but it came with the front double wishbone and rear 5-link suspension, the kind you usually only see in vehicles over 300,000 Ren. 3 large HD screens, Snapdragon 8155 chip, Napa leather seats. On paper, come on guys, that's absurd value. But here's the problem. Hardware specs don't actually equal experience. Go on any car owner forum right now. They complain about cars being stupid machines, screen freezes, voice assistants that don't actually work. So a company like Leapmotor could have Snapdragon 8155 processors and other flagship hardware, but does that really matter if the software experience is mediocre? So here's where Leapmotor's path gets really treacherous. They want to move up market to the 200,000 to 300,000 price point with their new A and D series, but look at who owns that space. Tesla with 3 superior electric systems, Xiaomi SU7 and their YU7 with massive emotional value and brand cachet, Huawei's Hongmeng with its legitimately impressive smart driving, Li Auto as well. In every dimension consumers actually care about, chassis quality, intelligent driving, overall experience, Leapmotor has a superior alternative. They position themselves as the luxury alternative, in other words, the value option, the cheap option. But when Li Auto launches vehicles at 240,000 Ren, offering 30% off, what happens to Leapmotor, the half-price Li Auto? It becomes irrelevant. And it gets worse. The Hongmeng intelligent driving is aggressively pushing into the 150,000 to 200,000 Ren range with actual Huawei smart driving tech. XPeng just dropped the G6 and the P7 Plus below 200,000. NIO's using battery as a service to bring competitive products into the 150,000 range. These companies are doing dimensionality reduction attacks. They take technology and algorithms proven at 300,000 Ren, and they bring them down to 150 to 200,000, and suddenly Leapmotor's value proposition evaporates. So Leapmotor is quickly getting squeezed from above and below simultaneously. The absurd reality is that to hit that 1 million units target in 2026, Leapmotor needs to go from 50,000 plus deliveries monthly to 83,000 plus deliveries monthly. That's a massive jump, and they don't only need to get there, but it also needs to be sustained. If they do, they'll squeeze into the first echelon. Scale kicks in, profitability stabilizes, valuation improves, and then they can afford high-end development. If they don't, they're stuck in no man's land. Not cheap enough to be a clear value leader, not good enough to compete on experience. As Zeus said himself, they won the war of resistance, they made it to break even, but they're not safe yet. So what's my take here? As a NIO bull, hearing about stories like Leapmotor remind me why NIO's strategy, while slower and more painful in the short term, might be the right play in the long term. NIO built brand equity, invested heavily in technology, and created a differentiated ecosystem with battery as a service and battery swap experience. Now they're leveraging all that to scale with Envo and eventually Firefly. Leapmotor proved that value pricing can get you volume. They haven't proved that it can get you sustainable profitability or the ability to move up market. That's the test ahead, and the Chinese EV market is ruthless. Monthly sales of 50K per month, which would make you a massive success in any other market, is not enough to guarantee survival here. You need scale, but you also need differentiation. You need efficiency, but you also need experience quality. Leapmotor's got time to figure it out, but not much. Anyways, that's it for this episode of the Courtside Financial Podcast. Camera's about to die, but make sure you hit the like button, make sure you hit the subscribe button, share the video, click the notification bell icon, and yeah, hit the like button as well if I didn't say that already. We'll see you in the next episode. This has been Obi with the CF Podcast. Thanks for watching. Goodbye.